All right, so this is start with problem 28, I guess. Getting bright in here. Those three curtains. Yeah. Okay, sorry about that, guys. So let's see here. So let's see if we can get a hold of this problem, see what's going on with it. Okay, you know what? I actually got something in here I shouldn't have. I didn't have these in there. You guys might have that at home. If you're playing, if you're playing at home, I may have sent that up by accident. So this is what the problem gives us in the book. So this is what we paid for the place. And this is how much the carrying amount of the assets were when we bought it. And here are the fair values. So the book values for these, and here's the fair values. That's all I had on here was the excess. Now there's something unusual about this. What is unusual about the excess assets? There's actually two things unusual. What are they? Anyone?
For me, it's like the customer relationships, 5-year remaining life.
Yeah, so this is one of those ones that is, it's a very common intangible, but it's almost never on the books. You cannot take an intangible or any assets developed that's an intangible that and put it on the books. You can only put it on the books at the cost. In other words, what it costs for, like, say, registering a patent or something like that. But a customer list, you're not registering anything. There's no registered patent or anything like that. However, oftentimes it's the it's the biggest asset in the place. For instance, you go into if you're going to buy out somebody's CPA firm, you buy out their CPA practice. What you're really buying is the customer list, their list of customers. That's what they're making money off of. So the customer list is often the most valuable thing you buy, especially for a smaller firm, and something like consulting or CPA firm, something like that. You're buying the customer list. I mean, if they'll have a couple $1,000 worth of computers or something in there, but for the most part, you're buying their list. And yeah, it'll be on the books at zero. Unless you buy it from somebody else. For instance, we're going to put this on the book at 75,000 because we bought that customer list. So that one's unusual. There's one more that's odd. What other one is odd on here?
The fair value for the equipment is less than.
Yep. This is the other strange one. The book values are more than the fair values. For whatever reason, they have more book values on their books than we think it's worth. And so we're going to actually have a negative asset. So that's going to decrease their assets. And the one last thing we got to do is figure out how much goodwill do they have. Oops. It was fun learning how to use a computer. All right. Oh, let's not do that. I guess. So we need to figure out how much goodwill they actually have. Okay, well, here's the excess assets. So let's add these up. Is that right? Yeah, that's right. How much do we have for goodwill? So these are the assets we have identified. Oops. We identified these assets of 4,500. And we'll make those orange. So the question is, how much goodwill do we have? If you're playing along at home, you can put it in chat too if you want. We will sit in awkward silence until someone figures it out. Oops.
$167,000.
Too high.
75,000.
Closer.
So it's like 205?
No. So think about this. So here's the book values that we have. So this is included in the 350. We have these book values. We don't know what the other ones are, but we know that these three that had different fair values and book values. So these are the book values. These are the only fair values that are different. They're excess. One of them is actually not an excess, but we're going to keep it in there anyways to balance it out. So the net, let's probably put it as net excess assets is 145,000. We know what we paid for it. We know what the carry amount of all of the net assets were. So the question is, we paid extra here. How much extra is going to go to goodwill? We've identified 145 of them.
55,000.
Yes, very good. So the assets that we have to identify is going to be the $200,000 difference here. Right? We paid $200,000 over the book value. Question is, what did we get for it? Well, 145 of it was So of this 200,000, 145 of it was identified. So this goodwill will be the unidentified. So 145,000 was identified. The unidentified amount was, we said 55 or 55,000. Let me clean this up a little bit so it looks a little more coherent. All right, so we identified 145 of it. The unidentified part was 55,000, so that'll be our goodwill. And that will take care of the whole 200,000 difference between what we paid and the book value. The fair values were increased and decreased by that one. Okay. Well, let's go ahead and start doing our SADI thing. Okay, SADI, by the way, it's on the first page if you. So SADI stock. Okay. They don't have additional paid in capital. Some states don't require it. Let's make that, what color? Blue? Make that blue. Okay, what else do we need? Where do we go to next? So we go here, retained earnings. And you'll notice that that is our beginning common stock and our beginning retained earnings. So that's the equity section at book value, which you'll notice is the same as that 350. The same 350. Okay, so coming down here, they got it in a little bit different order than I have it on my sheets, but the same thing. So here's the investment account. Let's make that green. All right, so let's see, we had to have a SADI. We have S. Okay. What do we do next? Assets.
Assets.
All right, so let's take a look here. Now, be careful because their assets are down here. Well, they have assets up here also, but the ones that are the long-term ones are down here. All right, so let's take a look and see what we have up here. So trademarks, we're going to,
1 lakh.
yep, so it's going to be 100,000 added on to trademarks. color should we make that? Oops. Red. We'll make it red. What else?
Customer relationship,
Yep.
$75,000.
And what else do we need to do?
Equipment,
And the odd thing about that is we're going to be decreasing our equipment. $30,000. Yeah, good one. Goodwill. So Goodwill will also be in there for, was it 55? 50, yeah, 55,000 for the Goodwill. Let's see here. And this one, I think we have more debits than credits, so I'm gonna assume that it's gonna be a credit to get rid of it. All right, let's see, equals that. That plus that minus the 30,000. Hey, that's it, right? That's what our excess assets were. It does look kind of funny though. I don't know why they'll be bugging me. They'll say, all these are Now look at that one. You're making it worse. If that one goes all the way up there, you can feel it. Start raising them all the way up. Beautiful view. Hey, we got the one back down. All right. Sorry, guys, I'm back. We're having window shade problems in the classroom. All right, so we are now up to the what, Ds?
yeah, dividends,
Dividends. Okay, so dividends, we have dividends of,
80,000.
yep. And so our dividends are actually kind of a weird one too, in that we are going to add these back in. They were subtracted out when we did our journal entries throughout the year for the equity section, equity method, I should say. And now we're going to put those back in. Okay. We have what now? Income?
Yeah,
Okay, so our income is,
210,000.
what color should we make that? We'll make that orange. Okay, so we're gonna take that income out of our investment. Okay, depreciation expense amortization. Okay, they split these up. Okay, the additional expenses. So we gotta come up here. Goodwill does not get written off unless there's a reason why you think you should write it off. Let's see, trademarks, these have an infinite life, so as long as they keep renewing the trademark, and if they are planning on doing that, you don't write those off, you just leave them on the books, whatever they are. So in this case, we'll leave them on the total 160. All right, so customer relationships, 5 years. $15,000. And the equipment is 10 years, but we gotta think about this one for a second. Well, let's do the easier one. Customer relationships, we're gonna amortize. This is an amortization. Okay, so we'll come over here. Amortization expense is gonna go up by 15,000. Blue. Okay, what do we do with, this is the depreciation. What do we do with that? Yep, it's actually going to reduce our expenses by 3,000. So that one's a little bit wacky. That will reduce our expenses because they're depreciating 30,000 of assets that we don't have on our book. Not that they're doing anything wrong. It's not that this is necessarily overvalued, because the carry value is not really a fair value if you're trying to allocate the cost over a period of time. So if they're doing it on a straight line method, for example, it could very well be that the fair values are different. And it could be different, more likely to be different because those are newer assets. You know, when does a car depreciate the most? When you drive it off the lot. It goes from being a new car to being a used car. So early on, you take a lot more depreciation, and that could cause a real big difference between the carry value and the fair value. As the assets go on in life, what's the difference between a 15-year-old car and a 16-year-old car? Probably not too much, but early on, there's much more depreciation. So this could be that they have newer assets on their books, and that's why you get that discrepancy. You know, when we bought it, it didn't have, those weren't new assets. Okay. So let's see, coming down here. Okay, so customer relationships is going to be E for 15,000. And that one is the kind of what we would normally think of it. Oops, where am I? Okay. The equipment, we are going to add 3,000 back onto it. Because that's how much extra they subtracted off of it. Because they have it at a higher value on their books than we have it on ours. What does that look like a mess? Neat. Okay, so let's see here. We'll start heading these up. So our assets were, or excuse me, our revenues were 1,645,000. Our cost of goods sold, I'm going to put these in as a negative. Oops. 528. Here's the tricky one. This 70,000 plus 70,000 minus, we're going to reduce our expenses by 3,000 because, oh, I gotta do this math. Wait, 145 minus 3, yeah, 140. Okay, so it's 142. So notice that we reduced our expenses by 3,000 because we're not depreciating as much as they are for those assets. Amortization expense is increasing. Customer list. Which again, for small, especially for things like CPA firms and you know, tax businesses and things like that, those are probably the largest assets. Okay, income. This is a credit. This is a debit, so this will be 0. Now, we should come out with a net income of this, 935. And let's hope we do. Yay. Question on that? And again, we already have accounted for the income from O'Brien over here in the income from O'Brien account. So when we smash them together, it's going to be included in there. So the income will be the same. And these, what do we do with retained earnings? Yeah, the only things that they're going to be left to the parent company. You can actually just copy those over. I'm going to put
Professor, how did you get to 40,000 for the negative 40,000?
the amortization. We apparently we're amortizing something on our own books for the 25,000. So the 25 plus the 15.
Okay.
I'm not sure what we're amortizing. I can look down here and see. Probably trademarks. We probably have some, maybe I have some trademarks that we're amortizing down here. There's nothing else there that would look like it'd be amortized. But maybe there's some trademarks that aren't going to last forever, you know. We have a trademark for the. They say what these people do? I don't say what they do. Let's say they're a bakery. We have the best bread in 2025. You know, if you have that trademark, you're going to advertise it, but after 2025, it's not going to probably be worth too much. Okay, and this will be. Oops, I'm going to put this in as a negative just because it does get subtracted out, but it should be exactly the same. If you just copy them all over, that's fine too. So these will be exactly the same as these over here. Ooh. And if you don't have the negative in there for the dividends declared, that's fine, as long as you have the ending balance of 1493. Okay. Assets. And those plus the debits minus the credits. I'm gonna copy it all the way down. No, clean it up. Okay, let's get rid of this stuff here. Okay, so this is minus that, minus that, and this should come out to 0, and it does. And again, we got to get rid of this investment on our books because it's already included in the total asset. You know, we picked up their cash and all that. So this entire company is actually included in with our accounts on our company. So if we didn't take this account out, it'd be counted twice. And again, this is what the consolidated financial statements would look like. Except they'd have a total here. Isn't that a thing? And again, we're gonna, so on the assets, anything that's on the debit side. Plus anything that's on the credit side, we will minus. They're almost invisible. Things only I can see for 100. Okay, oops, wait, they did that one. All right. Coming down here, the liabilities, we'll add those together. We owe our liabilities and for the subsidiary liabilities. And then similar to what we had. Oops. The subsidiaries, well, the stock will be gone and their retained earnings will be gone. They were getting rid of up here. We got rid of their income, their beginning retained earnings, their income, we got rid of their dividends. This all got zeroed out. So the only thing that's left are the parent companies. It doesn't look like it's gonna balance. But it does. Don't listen to me. So yeah, so that's. If you kind of want to reconcile these, if you look at the total assets for the parent company and it goes up by 136,000, you'll notice that down here, that's the only thing that gets added to the parent company's 136,000 for the liabilities. So that's what accounts for that going up. The difference is that. You know, it's all mixed in with the assets up here somewhere. But yeah. What's on that thing? What's that number for? I don't know. I put that in there for fun. Oh, that's the, oh, wait, I was talking about the, yeah, the, equity section for the subsidiary. Question on that thing? All right. Should we go on through or do you want to take a break? Huh?
Whatever you said.
Whatever I said, I don't like that. Anyone? Huh?
Break.
And
Break.
Okay, all right, we'll push through. We'll push through. Oh, wait, someone was talking from the Zoom. Any preferences in you want to take it?
Maybe after this.
Okay, all right. I tell you what, why don't we'll set this one up, we'll go through and figure out how we're going to split up the assets and all that kind of stuff, and then we'll take a break. How about that? We'll do the journal entries you come back. The journal entry shouldn't be too bad on this one. Okay. So Chandler bought the outstanding stock of Brooks for 100%, and it's already bold. Fair value consideration paid to Chandler was this. Okay, so this is what they paid for the company. The book value at the acquisition date was 105,000, and the patent was undervalued by, or patents, I don't know if it's more, was undervalued by 204,000. There's something that's unusual about this one. They paid 1,183,000.
audit value. Greater than what they paid.
Exactly. Yep. Notice that they got, I'm just putting over here just to add it up. They got 1,390,000. Maybe I do need a break. They got 1,309,000 back in assets from this. And maybe that's why they bought it, right? I mean, if someone comes along and says they'll sell you the company for 1,183,000, and you look up and see what it's worth, and it's worth 1,309,000, maybe that's the reason why you bought it in the first place. Okay, so they don't have goodwill. You know, they've identified, so these are the identified assets. So what do they have here?
Bargain purchase.
Yep. And you'll see that they actually even have it on the books. So there's not any goodwill. It's going in the opposite direction. Back in my day, 1,000 years ago, we used to call that bad will. But it's basically so 183, well, I should say probably say 1309 minus 183. Yep, and that is that bargain purchase. And no, hold on. I'm missing information on this. We're actually missing, what information are we missing? We won't be able to do all of our SADI unless we find it. Unless I'm looking at it, not seeing it.
Appreciation one.
Oh, no, here it is. I'm being stupid. I'm sorry. Here it is. They are showing it. Okay, so I'm sorry, so this is for the patented technology, the year's life, and yeah, okay. All right. Well, I tell you what, let's go ahead and take a break. We'll take a break and come back. If you want to start filling it in, you can. There's nothing wrong with doing it ahead of time. So let's say what time is it? 6:53. So we'll be back at what? 7:03? And again, if you want to work ahead a little bit and see if you can figure that out. You're not going to do anything with the bargain purchase other than just leave that on the books. This is a one-time deal. It'll be on the books. It's already on the books. You're not going to do anything with it. You're not going to eliminate it or anything. Because notice we're going to put this on the books at what we paid for it. You know, so this will actually be less that investment. You know, this would be the difference between those two. Because we're going to put more things on the books than we actually bought, but this will add into the equity section to make this down here. The retained earnings down here will be higher. Okay. Oh, that's true. Chicago. Wow, sorry about that. Income. Okay, so Sadie, we need the E, I'm sorry. The expenses would be 204 minus, or divided by 6,
34,000.
34,000. Thank you.
Yes.
34,000 will go in. Okay, they lumped the depreciation and amortization together. So was it 34,000 here? Yeah, that's fine. We'll call it orange. And now this will take off from the trademarks. This is one of the ones.
That's the technology.
Oh, thank you. This is wrong what I have here. Thank you, thank you. See Daisy. Then this has to come down too, right? All right, so this will be 4,000.
Mhm.
Good catch. Okay, I think. All right, let's see. So, oops. Careful, this gain is a plus. It's-
Yes.
Yeah, so that's gonna be yeah, add to it. Hopefully this comes out to be 560. Hey, and so those should be exactly the same. If they're not the same, just check your numbers, especially a strange one like this, because that, that bargain purchase, usually you're subtracting things, but that was gonna be a plus because it's a gain. And again, you would not have this the other way around. If it was, if you paid more, you'd have goodwill. Because you paid less, you have a gain. Okay, and this will just be these over here. I'm gonna put the dividends in as negative because they get subtracted out, but as long as you get your ending correct, I'm fine. As long as you get the ending retained earnings should be the same as this over here. So if you put that in as, like we have it over here as a positive, but it gets subtracted out to get the total. These are all credits. These are, it's a debit. And again, these dividends really did not go to outside shareholders. Those went back in the company. The only thing the outside shareholders got were these $100,000 of dividends declared by Brooks. Okay. And this one we hopefully will get about to be 0. Debits get added to the assets, credits get subtracted. There's something wrong here.
It's correct. I also got the same answer.
Oh. Yeah. Uh, yeah. You never know I was teaching this for 25 years, would you? Okay, so this is the difference between those two should be 106,000, and it is between these two. Okay, let's see. I shouldn't have done that. This will be okay. Wasn't that the last thing in chapter 3? We're gonna have a practice exam, and the exam will be similar to this. And this is very similar to what you have in your um okay. Okay, practice exam. All right, I don't think I sent it. Did I send you guys a practice exam at home? I don't think I did. It just occurred to me. Let's see here. You know, I don't think I sent this to you guys. Let me send you guys a practice exam. If you're,
But it's there on Blackboard.
yeah, it is in Blackboard. I'll send it out also though, because some people may not be in Blackboard. Uh, and it'll be very similar to what's on there. Particularly the write-off in, number of years. I used to change that and, one of the few times I've actually had students start crying taking a test and I couldn't take it, so I'm gonna leave it at 10 years. The two times I've had students cry during the exams are, statement of cash flows and this. Okay, let's see here. Okay, those of you playing along at home, if you are not in Blackboard, I sent it through your email. You should get it shortly. Okay. Oh. This is wrong. Do you guys have 5 years or 10 years on the building?
10 years.
10 is correct. What do I have 5 on here? Oh, I didn't change this one. Is there anyone that got 5 on there? Is that,
I got 5.
change it to 10 if you would. Must be in. That's. Huh. I just pulled it up in the thing here. Don't see. Wait a minute. Yeah, let me go to Blackboard and see what they have. Okay, if you're using Excel, change that to 10 years. Uh, yeah, so change this to 10 years. Was 5, but I altered it. I'm mad at myself. All right, so if you're using Excel, let me just go ahead and correct the Excel and send it back out. Okay. Okay, I got net identified assets at fair value of 132. Compare that to what we paid. Did you guys get goodwill of? Yeah. So the goodwill or the unidentified. I don't like that term, but I guess it doesn't matter. I don't know what else to call it, so. All right. All right. Oh.
Professor,
Mhm.
dividends declared. Wouldn't that be treated differently than dividends paid?
Actually, it won't. Now, if they did have dividends that were not paid, they'd be down here in a liability.
Okay,
But yeah, but they would still, because once they're declared, there's a legal obligation to it. So you'd still take it out of the retained earnings and you'd pick up the liability down here. So it'd be like you'd have additional liability and you'd have less in retained earnings. Yeah. It could be they put them in accounts payable. They could lump them together. If these weren't paid, they could be lumped in there. So what am I also need? Okay, now expenses. Now those were that 10-year, 5-year thing comes into play. Make sure you use 10 years on the E20. Oh, I don't think it's gonna balance. The beginning retained earnings, the 42,900 plus those, it might be wrong. 19,800, 49,500 plus 49,900. Is that not come off of that? Let me try that again. I think it's a,
Yeah, that's correct.
okay. I did miss something here. I know what I missed.
The income,
Yeah, I put this where I should have the income.
yeah, there will be the income. So it will be 12,540.
Let's give that a different color. Okay. And the E, now this will go here. I think that's it. Well, we'll find out. And unlike the last one, this expense will increase the expenses. Because we have more assets on the books. That should be 0, this should be 0. I'm nervous on this one, but I'm hoping I didn't change it to, well, that comes out right, so. So far, so good. And again, these will just be the same as the ones over here. I missed good, oh wait, here's Goodwill. See, I didn't miss it. What are you saying? I missed it for. All right, so these two will go. All right. And then again, this is just the only thing that's gonna be left is the parent companies. And they do match, yay. I corrected the calculations, I just didn't correct it. How many years to do it for. Okay, well, the next thing, I'll leave that up for a second. I'll leave it, give you guys need. Let's completely. Okay, I'm gonna come back. I'm gonna give you guys the, I'm gonna get the printed tests. I have them printed. Bring that with me. It's not enough though. Okay, so for you guys playing along at home, the chapter. Oh, okay. Yeah. Pre-exam will be emailed tonight. And it is due on Friday, I think it's the 19th. Friday the 19th. Wait a minute. Am I not sharing my screen? Why does it look funny? Oh, it is sharing. Okay. All right. So tonight, we're done with tonight. The exam will be emailed. Now, those in the classroom will give you your exams momentarily. But so if you're at home, you'll be emailed it tonight and it'll be due on 4/19. Any questions?
Yeah. Just a second.
Okay, so time I'm gonna check in the chapter. Yeah.
You said before that. Wait a minute, hang on, I gotta get my notes here. The difference between the combined asset total, ending total, and the beginning asset total of the parent. The difference between the two of them is supposed to be the accounts payable.
Actually, it's all the liabilities. In this one, they have more than one liability.
Oh, okay,
So
Okay.
it should be that. I don't know. I don't know.
so, okay, that's why I.
Yeah, so it'll be those two together. I think in the problems, the textbook problems, I think we only had one liability. Okay, let's see here. Okay. Yeah. 490. Okay, any questions from anyone? At home or in the class? Okay. All right, well, I'm gonna stop sharing because I don't like sharing. Any questions, in the Zoomiverse? No? Okay, I'll see you guys in a week, and, I will be emailing the exams out, tonight. Probably at least by 10, they'll be out. All right, see you.
Thank you, Professor. Good
Thank you.
night.
Good night.
Thank you, Professor.
Thanks, guys.